Hello, everyone. Welcome to Red Summer Holdings, a real estate partnership comprising of 8 owners: Tochi, myself, Zoe, Ramad, Charles, Ikechi, Chima, Innocent, and IK. Here we discuss the evolution of our business, which shows you how group economics can be successful in regards to real estate. If you believe there is value in this information, please like, comment, share, and subscribe. With that being said, let's get to the content you've all been waiting for.
I had trouble finding people by projects on all of these sites, so I asked him, and that's what I came to. If we have any other suggestions, though, I don't care. I don't care who does it. I just want it to get done. But that will come out to roughly like $40 more a month in payments for us each to get that done. But I shouldn't have jumped that. I'm gonna go back to Zoe and then to IK, and then we can come back around. So Zoe, you're up.
Yeah, so I was just thinking that we put it into a percentage into Alibaba, put a percentage into a high growth stock like Square or another one called TTD. That one involves digital advertising. Those are two growth stock options, and then I guess we could put it into something safe like Apple. Apple is an overvalued stock, but Apple's going to be here for the next 10 years overall. So I think that would be a pretty safe stock to go into. I don't have all my paperwork or my research in front of me, so I wouldn't be able to give you guys like an in-depth analysis of each company. But for Alibaba, I truly believe that it's a major leader in its industry in China, and I think it would be nice to have diversification away from America, given that there's been so much inflation happening in this country, and the fact that they're going to increase interest rates, I think will cause a slowdown in terms of people investing in stocks. If anybody disagrees, they could chime in. And I think that Alibaba overall is super undervalued for the amount of cash flow and revenue that's coming in on a quarterly basis. So it's a very useful stock all over the world. A lot of people even use Alibaba as like almost like a wholesaler. They buy things off of Alibaba and sell it off to Amazon. Alibaba brings in a lot of money into the Chinese country. So I just don't see, like with all the talk of delisting and all the talk of China eventually, I guess diminishing the company overall. I don't see that happening because they're more beneficial to China, being a company that continues to grow. And also Alibaba reminds me lightweight like Facebook from some years ago. Facebook was doing some things, whether it's, I guess, stealing people's data and things of that nature, and the government got into it. And a lot of investors too, were scared that, the government was possibly going to be a major influence on how Facebook operates. But at the end of the day, and during that time, I mean, it was 100, and then, a few years later, it popped up back to 300, and there is no government control over Facebook. And I feel like that's the same exact thing that's happening with Alibaba. And when I select stocks, I kind of go back to what has happened in history with other companies and the results that eventually happen with them. And again, Alibaba is, to me, it's the same things happening with Alibaba as it was with Facebook a few years ago. So I have high belief in that company. The stock price, based on the revenue coming in, the ability to cover debt and things of that nature, should be at least like 200, and right now it's like in the 130 range. And so I think long-term, all this Chinese, headlines and such will go away, and Alibaba will continue to roll. As for Apple, I feel like they're just going to get into a whole bunch of different things. I believe they're going to get into healthcare down the road. I believe they're going to, definitely come out with a car. I think they're definitely going to start to, I guess, diversify and not just settle with, okay, iPhone and hardware and things of that nature. I think they're gonna, and I think they're going to even go into the streaming services. I mean, that's all speculation until it actually happens. But tech companies nowadays don't just settle for, okay, this is the one thing I do. They diversify into other things because, you know, they don't want to be the next Blockbuster where they're, okay, I'm just gonna, you know, keep on selling these videotapes and just stay there for the rest of my life until I die. They tend to diversify into other things, and they have plenty of money available to implement testing on, okay, can we go into AI? Oh, can we do a car? Oh, can we, you know, go into streaming and things of that nature? And I think Apple is a major player for the long term, you know, 10 years from now. Squarespace. Oh yeah. So I was telling you guys, like, they're diluting shares. When it comes to, and if anybody, because I'm not a professional, if anybody wants to chime in, let me know. I was telling you guys about share dilution, where they're basically like issuing more shares overall. But what I noticed is that they actually bought this company called Afterpay. So share dilution could be bad if you're issuing more shares, and then, for example, the CEO is taking more money with those shares that are being issued or something like that. But they could be good if you're using those shares as an investment. So basically, they issued more shares to a company called Afterpay. Like, I want to say like a fifth of the company shares to Afterpay. And Afterpay is like an Affirm, essentially, where they where you could buy now, pay later kind of thing online, and that's beneficial to today's society, given that, you know, people don't have all the money to pay for things at once. And also, it's better than using a credit card to buy stuff because you won't get inundated with a whole bunch of excessive interest on your, you know, payments and things of that nature. So actually, Square made, I would say, a good move in terms of diluting shares or creating more shares, because they used it to do something that they probably will be beneficial for them for the long term. Because if you guys know anything about Affirm, like, their stock is doing very well, and they're in that business of, you know, buy now, pay later, pay over a period of time without including too much interest on your payment. So I thought Square was actually a good stock to buy for the long term, although it is overvalued, but it's a growth stock. So with growth stocks, those things could, you know, continue to fly. And given, you know, I'm just bullish on e-commerce in general. So yeah, I would go with Square. And what was the other one? Apple. I think I hit all of them. Right? So yeah, I mean, that's just my opinion. If anybody else has any other opinions, feel free to chime in. I know that Chima wanted to do like an ETF or an index fund. So we could figure out if we want to do that. Anyone could discuss any index funds, any stocks they're interested in.
Yeah, I think
That's all.
Yeah, I think and I agree with everything you said, to be honest. But I think having an index fund, or I mean an ETF as part of that as our safe bucket, as opposed to a single stock, to me just gives me more solace.
Yeah, that's fine.
You know, yeah, so saying whatever it is, whether it's, you know, just you know, like an ETF that tracks the S&P 500, but IVV is something, you know, that just tracks the S&P in general, as the quote unquote safe bucket. In terms of, you know, fintech stocks, Square, I think Square's a good company. Michelle's in fintech space, talk about Square all the time. Pretty much things, you know, things I hear people, like lay people talking about, as in they're starting to use more and more in their life, and use other things less and less, are always a good thing. Some people are saying, I'm starting to use, you know, Microsoft Teams more and use Slack less or whatever. I'm thinking, okay, maybe Microsoft is, I mean, I like Microsoft stock anyway. I think it's probably a good one to get into. Yeah, but I think I agree with everything you said. It's, you know, just adding the ETF to the.
Yeah, I'm not opposed to
portfolio.
To your point, though. To your point, Zoe, on the share dilution piece that you were talking about, I'm just looking up some of the numbers behind it, and so like the closing price of Square around the time of the acquisition was, let's see, $247 a share, right? And so with that being the case, and they paid them in shares, in stock. Since then, it's been a little rough for Square in that the price of the shares are 133 right now. So the fact that they paid them in stock was advantageous to Square, because if they paid them straight up cash, 247, a share or the equivalent, I think the total amount for the purchase was, let's see, should have just lost it. I think it was like 29 billion. But so basically the 29 billion they paid him in stock is worth about half. So it's better for Square, the corporation, than Afterpay, because not only do they not have to, put any cash up, but the amount they paid them is actually ends up being less. And then if you consider inflation, it's even smaller, right? But my only pushback, and not necessarily a pushback that says, okay, we shouldn't invest, is that with a company like Afterpay, and I think that this is why Square's stock actually took a bit of a dive in the last, 6 months. Square's total market cap as of right now is $61 billion. That means back then it was somewhere in the $100 billion range, and they paid 30 for Afterpay. So you do some loose math, and they basically lost the value of Afterpay. The reason I think that that's the case is because with Afterpay, like how it works basically is Square is taking out a credit facility or a loan to cover the cost of whatever goods the consumer is buying, and the consumer is paying back over time as Square services the debt for the initial cost. That's great in a low interest rate environment, but if interest rates are increasing, over time, upwards of 2% for the next year, then the borrowing cost for Square will also increase, therefore making it less advantageous to effectively lend out the money to consumers and get paid with inflated dollars down the line. So not only are your interest rates going up, let's call it 1% over the next year, but also the buying power of the dollars being used to pay down the debt to Square's lender is going to be less. Therefore, it's a net negative for the lender in that scenario. That being said, it opens them up to a larger, customer base. And generally, when interest rates go up, that's good for financial companies for other lending practices. So I actually do like Square, because I'm looking at their growth. They're doing 49% over the last 5 years annualized. Their PE ratio is still very high, but it's come down a lot. And with 50% growth, I mean, like you can afford to pay a little more for your earnings, especially in an industry where more often than not, people our age, millennials, are opting for the use of a Square or a PayPal by way of Venmo to do their transacting. And the more data that's collected using Afterpay and the like, it's just better for Square because they can offer more. They can offer more deals. They can offer more. They create different revenue verticals in the small business space with the technologies they already have in place. So I like Square. It may not do very well for us in the near term because of interest rates and the fear that that's striking in the heart of growth investors. But I think long term, Square is going to be relatively strong.
Yeah, and then the other thing I would add on is that they have the potential to increase prices or increase fees. I don't think they've fully increased fees in terms of Cash App. They haven't fully increased fees or in the Afterpay. I think that's in its infancy stage, because I've noticed for PayPal, for example, Venmo, before everything was just completely free, and then they're like, okay, well, if you want it in 1 to 3 days, we're gonna add a fee to it. So those are all potential
new revenue.
I mean, it increases it increases the growth potential of the company in general. So yeah, but I hear you in terms of in the near term. I mean, they're gonna suffer for sure.
As terrible as it is to say, you shouldn't. If I'm Jack Dorsey, I'm running Square or Block, whatever the fuck you want to call it.
Yeah,
I'm not terribly concerned about cash or earnings at the moment. You need market share. You need to capture as many people, as many transactions as possible, because like the payment rails are still dominated by Visa, MasterCard, right? And they're collecting their VIG on every transaction. So if you can, you know, be a sticky product or service in the financial services space, in a transaction space, then that's more important in the long run than whatever, you know, margins you're making, because people, like small businesses, don't want to start like price shopping, don't want to use Square or Toast or whatever the fuck else, you know, they have out there. So I think that capturing market share is super important in that specific space. So the growth, like the 50% revenue growth, is more important to me than whatever PE ratio they're trading at right now.
Yeah.
On Baba, I 100% agree. I think that's probably our large position. Because I mean, so like just the quick and dirty numbers on Baba, similar to Square, down a significant amount. Like it's the highest it was traded at 320 at the end of 2020, and now it's at 131. So more than half, right? More than half. And if you're looking at what did I just do? Sorry. If you're looking at like valuations, this is nuts. Baba's trading at a forward PE of 15 forward PE.
That's disgusting.
That's ridiculous.
And they're making more money than they were probably like 5 years ago, I think.
I mean, to your point, make the quarter over quarter, quarterly year over year growth is 38%. Annualized growth over the last 5 years is 46%. And this company is trading at a 15 earnings. Why? Because we're scared of the Chinese government. Look, if that's the risk we're talking about, Chinese government risk, that means that it's either they're going to close the company down and shut it down completely, or they're going to let it. So basically, we're saying, okay, is Baba going to go to zero? That's the question we're asking us. Do we think Baba's going to go to zero? Well, at this point, it's trading at half of what it traded at its all-time high. So it's basically a 50-50 of whether it's going to go to zero or back to its all-time high. And I'm willing to take that risk if I'm only paying 15 on the forward. So I think Baba should probably be our largest position, because I think it's a golden opportunity, and all we're scared about is regulatory risk from the Chinese government.
Yeah, I think it's I mean, but in some token, like China did stop, what was it, D from listing on the New York Stock Exchange, right? And
wait, say that again, Chima. I didn't quite hear you. Say that again.
Was that company Didi? It's the biggest.
Financial.
Yeah, but that has nothing to do with Baba. But go ahead.
I know. I'm gonna say it's I think China has made a deliberate point to rein in, you know, large companies that operate out of China, right? You know, and that's just across the board. I think it's part of it's part of their, I don't want to say worldview or concept, or how they're maneuvering for the next evolution. And I don't think anybody really knows what their end goal is or why, but they are reining in the big companies in China. So the risk is not zero. I mean, there is
no, it's not zero. I would say, like, I would 100% agree that there is some, you know, it's very tentative in China in terms of like them trying to rein in and retain power from the billionaires that have sprouted out of the last, you know, decade. But what I'm saying is that I'm 100% willing to take that risk if I'm getting, you know, basically the Amazon of China even stronger, because they have like a financial component, they have other components. So if I'm getting that company at a 15 PE when the S&P itself trades at 26, 27 PE, and the S&P, you know, consists of companies like Procter and Gamble and like you know, Danaher, like these boring companies that are probably doing 4% year-over-year growth, and Baba is doing 50% year-over-year growth, and I'm getting it at a better valuation. That's like that's like to make the equivalent of real estate. It's like buying, you know, a 10 cap in Brooklyn as opposed to buying a 5 cap in Nashville. Like the risk is there. There's like, or let's put it in California to you know, adjust for the rent control risk. The rent control risk is there in California. Like it's hard to navigate the regulatory side of it, but I don't care if I'm buying it at a 10 cap, right? I'll just eat that risk. I mean, every investment has some risk, I'm more than willing to eat it if I'm getting such good value. And I think that's the case with Baba right now.
Yeah, no, I definitely hear it. I definitely, man, yeah, it's yeah, I mean, I can't argue with any of that. It's it's but just the very fact that China can just like say, okay, you're the CEO of the company, come with us, and you go missing for a bit and then reappear. That's kind of that's scary, right? I mean, that'll cause any company to drop. Especially, yeah, it's I don't think it's clear exactly what China's doing, right? From their maneuvering in Hong Kong to all the Hong Kong-based companies, right? It's they're certainly clamping down, socially and economically in China, right? So I think it's I'll say it's what's the saying? Fortune favors the bold. So it's certainly worth the risk as long as we're all sort of aligned in that point. What do you guys think about? So I think, what do you guys think about PayPal as a company? It seems like because PayPal is bigger than Square, and PayPal's around the same time frame that Square started to drop, PayPal started to drop. So PayPal's gone from like trading like that almost 300 to today it's like around like 180, and I think it's fundamentally changed. Similar to Square, right? It's just I can't really quite figure out where that stock is going, but I still expect it to go higher. So for the same reason I like Square, I think I like PayPal as a company as well. Have you guys looked at PayPal stock recently?
Yeah, so I haven't like looked into it in depth yet, but I do like PayPal. But the thing that just like as from a consumer standpoint, I feel like PayPal is not as frictionless as a company like Square, meaning that if I go online to pay for something, I feel like it takes me through multiple steps. I don't know if you guys have experienced that. Like, as opposed to something like a Shop Pay or something, literally all my information is there. I click it once, boom, I'm done. But for PayPal, I need to kind of get off of that, I guess, the transaction part, go onto the PayPal website, and then I start the whole transaction. That's the thing that I'm not as high on in regards to PayPal, just from a consumer standpoint. I don't know if somebody could like address that in detail. And then the other thing is, I don't know if they have a platform like an Afterpay or Affirm, because I feel like that is going to be something that's major in the future. As inflation, well, I mean, now inflation's super high, the cost of things are higher. So as opposed to, am I going to go to PayPal to try to do that? No, because they don't have that ability yet, right? I'm going to go to a Square or an Affirm, but I'm just speaking from a consumer standpoint. So
yeah, because
you guys
on the
can
back
chime in
end,
about that.
They do a lot of things on the back end, things you don't know, even though they're involved with on the in terms of facilitating payments for companies, right? So it might be, for instance, whatever, Nike.com, whatever, right? And they might not be a PayPal logo on it, but they facilitate. So they have a lot of accounts and a lot of users who don't show the PayPal badge, but PayPal is a company that processes all the payments on the backside, at least online. So it's I mean, they're probably worth at least 4 times worth Square's worth. They're just they're the big player in the financial technology market as far as that's concerned. Just a thought. I was just seeing what you guys thought about it.
PayPal has legacy. So PayPal, they were like the first major online transaction like platform, and they have a lot of legacy tied to that. Their issue though is that they don't. To me, it looks like they don't know. They know they need to pivot, but they don't know exactly where they need to do so. And in fact, the one place that they did that I know of that they pivoted, it's sort of a mistake, because I think they tried to go into credits and tried to start like handing out credit when they should have done the opposite and done what Chizo alluded to with Affirm, and like basically like a reverse credit, if you will. That was the first issue. The second issue is the fact that all these smaller players that are more nimble are doing other things better than PayPal would do if they pivoted. And then they're also starting to go into what PayPal does. So like, PayPal's issue is somebody like Stripe. Stripe does what PayPal does with much less friction and much easier to implement in your systems. And then back to PayPal versus Square, PayPal is stronger in what it does than Square is in what it does, but Square has a couple of things that PayPal sort of wishes they had. So like Square is tied to Cash App. Cash App essentially does, you know, a lot of what PayPal currently does already. Also, PayPal tried to do hardware. I don't know if you guys remember that. I think they had like a triangle piece, like a credit card swipe piece, that didn't really do too well because
that's bad.
Yeah, because Square, remember Square has their original, like now Square is like, you know, where you put your card is like kind of automatic. In fact, they have like a whole register for physical locations. But before, you remember the when
like that was
it
originally
still
called Square. It's that little
right,
square thing.
there was that little square piece where you could port it and just have a business there. Square has evolved now to, again, the register, but PayPal doesn't have that. So the Square is in your store, and you know, any business, we learned this from Apple. If you can get inside the door, then that's where you want to be. You want to be inside where you have many more opportunities to flip your access to a transaction. And so PayPal has legacy and they're very strong, but I think for me, they're lacking direction. So I say that to say that they're a safe bet in that you're less likely to lose money with them and they'll be there a long time, but it's not as assured their upward trajectory in the future, to me.
Yeah, I also think of, I mean, that's, what I guess my point is that there are things we know PayPal does and things we don't know that they do, right? So in some sense, like we think of Amazon, we think of Amazon as like, you know, deliveries and groceries and, you know, everything we need, you know, the tangible things we see and feel, but we don't necessarily think of like Amazon Web Services, right? Which is probably the biggest like revenue generator, right? So it's the other things that PayPal does, which make them a lot of money, which we don't actually see and feel. I mean, not to count like Venmo and Honey. I don't know if anybody uses Honey, it's like the coupon company, which they own. But yeah.
I would say PayPal is like Eno said. I mean, the first mover advantage was very strong for them. They were around much sooner than any of these other companies, which gave them the size that they're at today, like double or triple the size of Square. I would say PayPal is more of a value play. I mean, relative, right? Because obviously not a value play like a Procter & Gamble or like a Clorox, but like relative to the fintech space, PayPal is more of a value play. Just to put some numbers behind that, like we already discussed. I don't know if we discussed Square, but PayPal's revenue growth is like 13% quarter or year over year, 18% annualized over the last 5 years, and it's trading at a forward of 33. For comparison to Square, just to sort of give that relative revenue growth over the last 5 years, and it was 49%, like we were talking about before, year over year, 26%, but its forward is 70, and its current PE ratio looking backwards 12 months is 124. So you're paying a lot more for the earnings that you're receiving with the expectation that the earning is going to grow at a quicker pace, which is why I would say relative to that, PayPal is a value investment. But I mean, with components like Venmo, which also has some first mover advantage, and just the data that they can collect from consumers, it's almost like they probably are going to have more at bats than a company like Square, because I mean, they have like 15 billion in cash. Like they could buy an Afterpay company if they really, really wanted to. It's just that, like, as of right now, their product seems to be waning in its cutting edge, you know, its ability to capture customer base, but they already have such a large market share that that's not that big of a problem yet. So it's like, you know, said, it's like a safer investment, PayPal. But if we're looking for growth and to sort of go a little farther out on the risk return, you know, horizon, then Square is the play.
Yeah, and going back to like the payments part, like I don't know how many times you guys have used Venmo to pay at a you know, like a